everyone's attention. Super excited to be hosting Sergio and James today. Two great, really accomplished people that I think are going to leave us with some great messages. I'm going to spare them the introduction and let them introduce themselves. Sergio, if you want to go first.
Sure. I'm so happy to see you all because I can't believe we kind of filled a room in the middle of midterms and all this stuff that you guys have on. So it's amazing. It's amazing. And thanks to Moneta and Winston for co-sponsoring it with Shea, and Jerry Doyle can be here. So Wesley is here. So it's amazing. A lot of people here. I wanted to just spend a few minutes talking about my history, my journey, and then I'll pass it over and then we'll answer other questions. I'll start from the beginning. I was born and raised in Mexico, came when I was 13 to the US accidentally, not speaking much English. Came to San Diego, so I'm West Coast. And then loved math, science. Went to undergrad at Stanford, where I landed in a little hall called Roble Hall that happens to now be the oldest and the most prominent there. But the reason that's important is because it was the most progressive in a place that I consider to be pretty interesting, which is Silicon Valley. There was no such thing as entrepreneurship or Silicon Valley back then when this dorm got created. It's important because I named my fund that. We'll talk more about my journey all the way to the fund that I have, which is called Roble Hall. The reason that's important is because the hall itself was very inclusive. It allowed the first time that it admitted women into the college, into the dorm and the college, and this was in 1919, or like I said before, Silicon Valley was really started. From there, I studied engineering there, so we could talk more about my journey there. But then I went to investment banking. A lot of you are going to end up there. I took a class sophomore year that really fired me up in financial engineering, financial accounting,
Financial accounting fired you.
Yes, that's another psychotherapy for later. But I got just super enamored with Wall Street and all of that, and so I went to Morgan Stanley for a couple years. After that, I said, hey, I want to be kind of closer to tech, closer to sort of entrepreneurship land, but I didn't have much business. I had finance and I had engineering. So I went to business school here at Harvard Business School and spent 2 years there, really trying to hone my skills in a variety of areas in business. And then my second year, I actually used that to really put myself on the map in terms of software and technology by doing internships for the full year, my second year. And so I landed into Silicon Valley at a startup, did all kinds of things startup related from the operating side. So I did a company that we took public. So I was early manager in marketing, moved from finance to marketing. Then I went on to be, to do eBay, which is an early startup that actually did well and still around. Then crashed the company. I got funding, from investors, lost all their money and crashed it. And then later on, I did another one. So it's all kinds of variety of entrepreneurial sort of hiccups and ups and downs. And 14 years ago, I then started in a bigger firm called Roble Ventures Partners as an investor in venture capital. I accumulated a lot of skills that I didn't know I was accumulating. And so it was a very sort of up and down career all the way to when I started in venture, made all kinds of mistakes the first 4 years. The next 8 years, I started honing my thematic approach around education, technology, future of work, and sort of technologies that help a lot of people get socioeconomically ahead. And that's what I now call human enablement technologies. And that's how I started my fund about a year and a half ago. Very much focused on seed, $500,000 to $2 million checks that I invest in seed companies where I help them build a great board, a great team, and get them to the next level. Eventually, hopefully to be like some of my companies that have gone public and did some great M&A exits of some sort. So with that, I'm going to pass it over to James. I went on too long, but go ahead.
I think you understood. You had a very good run at Norwest, which is why you were able to raise your own funds. So I'm James. I am PC class of 2000, which is a really long time ago. I rode any crew, PC crew here. No rumors to that. I wrote for 4 years. After BC, I went to law school at NYU, lived in New York. My wife is also, she's class of 2001, so we met and moved to New York. I worked at Sherman and Sterling in New York for 5 years, doing mergers and acquisitions law. I worked for the Red Sox for 6 months as a secondment, which was fun. And I realized that I didn't want to go back and work 90 hours a week anymore in a law firm. And so I got a job at Google and moved to the West Coast in 2010. And after Google, I went to Yahoo and stopped being a lawyer. So I moved over to corporate development, which is think of mergers and acquisitions, but from the business side. Did corporate development at Yahoo, went to Andreessen Horowitz, which is a venture capital fund, and did corporate development for them. And then I was at Square, now Block, for about 5.5 years, where I led their corporate development, M&A, and investing for the first 4 years. And the last year and a half, I went to their Cash App division and built a corporate venture fund for them, focused on consumer fintech. And then in July, I moved over, and I'm now currently the managing partner at PayPal Ventures. And so we've invested about $750 million since 2017 in 65 different companies, all fintech focused. Like investment sizes generally, call it like 3 million to 20 million, Series A to Series C. I think the companies that we are in that are doing really well internationally, we are in TOS in Korea, which I think 1 out of every 2 Koreans is a registered user of TOS. Pine Labs in India, which is kind of think of it as like Square, but in India. We're in Acorns, we're in Cameo. That's a kind of called that one fintech. So that's where we are now.
And you're in Roble Ventures.
Oh, and that's the other thing. Like, and so we also have $100 million that we invested about a year and a half ago as LP investors, so into other funds, into funds that are managed by underrepresented minorities. And the idea there is to see if we can take our investment dollars, put them through the LP vehicle, and try and solve the problem. And like, I think if you guys don't know this, if you haven't seen it, that like women, underrepresented minorities represent like a shockingly small number of the founders that get funded. They also represent a shockingly small number of fund managers as well. But so the idea behind this, and one of the reasons why we're LPs in Roble, is that the best way to leverage that $100 million was to give it to fund managers who then can go out and disperse that. Because obviously if we helped you build your fund, but there's, that money's then multiplied by other LPs that come in. And so that's part of like, I think, and one of the things what I'm really hoping for is over time, as we have a relationship with folks like Sergio, is how do we look at the pipeline that they're building, because they have different networks, they invest in different kind of founders. And I would say, by the way, half of those funds that we invested in are like, call it impact. So they're focused on investing in founders of color or women. And the other half are like Sergio, which is like they're straight, like they're investing for profit. But even still, like I don't know what your percentage is, but Sergio doesn't, like, you don't have it's not a mandated target, but he still has way more than average women and underrepresented minority founders. And so the idea that like different networks create different outcomes is kind of what's driving it. And so I think the way that it works is that then if for the fintech companies that come out of our LP investments, how do we get them in front of my investing team so we can start to get Series A investments into those founders as well? So
yeah, and I mean, I just add one little comment here. PayPal has been super supportive of us, and one of the reasons I started Roble, and I thought there was a lot of opportunities, because when I was investing out of the other fund, Norwest, sitting on boards that were really tiny all the way to IPO, I realized that if you put a lot of people from the same background, same gender, same sort of experience, same geography, it becomes like the board meetings become very much a self groupthink mentality, reinforcement in the discussions. There's no accountability to each other. There's no debate. So what I noticed is that the best functioning boards had a real good blend of different experiences. So it's part of the reason I'm here is because I believe that the Boston College ethos around sort of a purpose plus the fact that you really promote this diversity of thought is super important, because we don't have it as much we don't have it as much in some of the more developed companies because of what James said. This is the industry has been grown sort of almost like homegrown from just a very few privileged set of investors. So that's why I think we're going to be able to return a lot more, by having kind of this diversity of thought initiative when we start creating the companies from the bottom up. So sorry. Yeah.
No, awesome. I love you guys' answers, and you guys have some of the most impressive careers I've ever seen. Both of you are involved in BC in some capacity. James, you went here. Sergio, you didn't. Can you talk about the ways in which you're involved with BC and why?
So I'm on the board of regents, and that's actually why I'm here. I'll be here for that meeting tomorrow and for the football game. For my wife and I met my wife here. It's like a central part of our life. I think I'm not very involved at NYU Law School, even though I spent almost as much time there. I just think BC is a lot of why I think I'm successful and how I the lens I view the world I developed here. And so I think even though we're thousands of miles away, it's just really important for us to stay close. And so I think that's why we try and stay as involved as we can.
Yeah, my involvement was thanks to my daughter Bella, who's a freshman here. So don't mean to put you on the spot there, but so she actually enlightened me to the school. I didn't know much about it about 3 years ago when we started looking. And what I really, it was at the right time when I was thinking about building a firm that was purposeful. And so, in fact, I just had the discussion with Tim Klein, who wrote this great book, How to Navigate Life. And Bell Yang teaches the class in the psychology department. So if you want to take it, that's an awesome book and it's awesome teaching where you need to navigate your life not via performance or happiness, but via purpose. And that's exactly the way I was thinking about building my firm, that if you have a purpose, in my case, it's really try to help a lot of people, not just a few, but a lot of people get ahead socioeconomically. That's my purpose. I can invest in the startups, I can invest in the founders, help them grow, diversify their thinking so that they could actually come up with a right answer, even though it takes debate and it takes hard work. Then we're gonna have a better world. So that kind of gets me up in the morning every morning. And the funny thing is 3 years ago, wow, this school actually teaches that right from the beginning. When I went to business school, there's no such thing as a portico entry point, right? And you do at CSUN. So I do believe that if you teach business with ethics at the forefront, with purpose at the forefront, it's amazing. So I would love to hire more BC people because that mentality is going to just become more important in the next 5 years. I see this roadmap where business has been too much about sort of numbers and sort of single bottom line. I think that double bottom line is going to be the more important way to go down the road, especially with climate and things that need to be addressed. You need to think of your shareholders not just as shareholders, but the broader set of stakeholders. Your employees, your community, and to really think through that because that's going to become very important. And I know you guys care a ton about that, so that's why BC is an epicenter of the future, I think.
Yeah, well, we love to hear it. I wanted to talk a little bit more about you guys.
And I'm part of the PLC, by the way, Wesley. Thanks. The Parent Leadership Committee. Sorry.
All good. I wanted to talk a little bit more about you guys' careers. Although you guys had different careers leading up to venture capital, they were very similar in the way where you guys both sort of started off in these high-pressure corporate advising environments, so investment banking versus corporate law, M&A law, and then sort of got a little operating experience, and then eventually became investors. Can you talk a little bit about how your career has helped you be an investor and when it sort of, in that investor mindset sort of clicked for you guys, when do you think you became an investor?
Do you want to start?
Yeah, sure. I mean, I think career-wise, I think starting, I think we both started in professional services. I think the benefit of that is that you do a lot. Like you work really hard. You see a lot. You see a lot of different patterns, right? And I think that's helpful. You learn how to work. I think that's another thing that's important. But then I think over the rest of my time, especially doing mergers and acquisitions, it's just I think on the investing side, what you start to see is you're at the exit point, which is nice because that's obviously when you're investing, you're looking for either an M&A exit or an IPO exit. And so you really kind of, in all of the deals I've worked on, you're doing a ton of due diligence, you're pulling the business apart, you're seeing what works and what doesn't work. And I think that like helped me kind of understand like better what I think makes businesses work well and what makes them not work well. And so that like, and I think that like if you're taking it into more of a general view, it's really like that kind of repetition, like doing a lot of that and becoming an expert on it was really valuable. And when I finally had to go and say, okay, now I have to pick something, because there is like even up until before that, like on the M&A side, like deciding whether you want to buy something that's an established company is actually quite a lot easier than looking at something and trying to decide in 5 to 7 years if it's going to be a thing or not, like that. And so that was a skill that I'm probably still developing, I think, like, but having seen like many repetitions, like I've probably worked on over 100 M&A deals, and like in that, like having that repetition, so seeing 100 different, probably seeing 200 companies, like pulling them apart, seeing how they work, seeing like what a good CEO looks like, seeing what a bad CEO looks like, all of that like kind of like just fills into like when I then go to evaluate an investment now, that's kind of the lens I apply to it. Along with like I think just being in the industry, like I think that's like working at Square for 5.5 years. We were at the center of fintech, and so just like met a lot of startups, like saw a lot of trends, like worked with a lot of subject matter experts in the space. So it's just, I think it's an accumulation for me of experience that then you hope you can apply to picking the right companies. I think that is. Yeah.
No, I think I totally agree with you. I think that the thing that you said that I think I kind of gravitated towards is that if I were thinking if I was sophomore, junior, even a senior, I think of skills at the epicenter of what I need to have in the next 5 years. Hard, like really lay out your roadmap for skill development. Not so much like getting like nice little resume brands on a piece of paper. Is much more around the actual hardcore skills. You did it knowingly, unknowingly. You did it in law. I went to investment banking, and I feel like financially understanding a company, translating how business looks to how the numbers look in terms of the three statements was super helpful to me in the 2 years of hard work. The other thing about starting in a services environment is there's two types. I almost think of like my career in two different segments. One was when I helped others make a decision, meaning I was in the financial services, you're in the legal services initially, but that's you're an agent for decision makers versus the decision maker. So making the move, first being a service provider to the decision makers, being in what investment bank would be the sell side, not the buy side, meaning you're providing the service, not M&A terms, but financial services, basically advisory services. You actually have a client, so you have to be very service focused. And so being service focused also gives you the work ethic, gives you the skills. So I think it's a pretty good way to start. But then you have to think about what other skills do I need to end up in a job like VC that happens to be much more, if you're thinking of a sport, it'd be more like a decathlon where we have to do 10 things, but we're not really good at any one thing. We're just okay at 10 things. I think I was okay at finance. Then I took on product management because I went to operations. Then I took on marketing and so, but I'm not really an expert in either one. I just know what to look for. When I evaluate a company, I try to sort of figure out that the team is rounded, figure out where the risk factors are. So I think that's what the job requires. It requires you to kind of pick winners and help winners win, and that's the job, right? So I think if I were to go back to the undergrad days, I think in terms of that, the skills and also the mentorships that you're gonna have, like who is around you that's gonna help not only mentor you, but just propel you to those skills that you need to have and those relationships that you need to have.
Actually, that's like something you said resonated there, because I could tell you, like I've been very lucky. Like I've worked at some great companies with some great people, but I could also tell you, like each step along the way, like I did something more than I had done at the last. Like not just like obviously like you get more senior, but like actually like added to my job at each place. And I think that like that's so important. Like, and it's like it's less about like what like where you are and more about like is this new opportunity expanding my skill set? Am I learning something new? And I could take you through, I think it's what I do in interviews usually. I'm like, oh, okay, listen to the journey. And I went here because I wanted to learn about tech. I went here because I wanted to learn their business side. I went here because I wanted to take on managing people. And so each time I think being being really purposeful when you look at your career and saying like, how am I gonna get better? And like eventually your goal is to give yourself a unique set of skills, and then people want to hire you. And the more unique you are, the more likely you are to get hired. And I think I wish I could say like that was exactly the plan, in 2000 when I graduated from BC, but I think it's been more like a motivating factor than a plan. And I don't think you can plan it out, but you can always say like, how am I getting better? What am I learning more? How am I making myself unique at each new opportunity?
Yeah.
So.
That's super interesting. One thing I was gonna say, you just said how you interview. I always think of like the resume as poorly built, like it's an archaic system because you have a bunch of words in a job, and so people spend a ton of time looking at those words, saying, "What did you do in this job?" And then you have a blank space, and you have the next job, and you have a bunch of words. I always focus on the blank space because that's what we do in VC is make hard decisions, and your decisional moments are actually in the white space because you have to make a big decision from one job to the other. So I spend a lot of time, how did you make that jump? And so that's the white space. Nobody talks about, I was thinking about this move, and actually writes it down. Same as other moves, right, that are not in a resume, like personal moves. Like why did you decide to get, married, or like some big decisions, buy a house. So I think that's part of the job is making some tough calls and then adjusting, right? So having that entrepreneurial resilience and agility to be able to adjust on the fly. And so we don't have to have it planned out.
That's a go-to interview question for me. I'm like, I read your resume. Like, tell me about
what's not.
Why did you switch these jobs? Like,
exactly.
why did you do that? So it's like,
yeah, it's funny. Yeah, it's cool.
Awesome, guys. You mentioned mentorship. If you guys could expand a little bit more on that, how do you approach it, either as a mentee or a mentor? How have you sought out mentors? If you're a mentor right now to someone, how do you approach that relationship? And what role has it played in your career?
I went first last time.
Okay, I go. I think the role of mentors is going to become a lot more important in much more than it was in the past. So I wonder whether we have enough of that in formal education. The reason, I'll tell you why, because if you think about 50 years ago, 100 years ago, the economy was moving very slowly. So human adaptability, and this is part of my theme, human adaptability could catch up. You could kind of train yourself, get another job, or maybe have enough time to kind of catch up to the movements in the economy. But today, I mean, there's no surprise to me that we have such unemployment rate and we have so many jobs that are unfulfilled. We just need more skills so that we can fill those jobs. So the economy is moving very, very quickly, almost exponentially, just because decisions get done faster. You don't need the Pony Express. You can send an email. Things like that. So decisions get made faster means that economy or jobs move faster, decisions need to move faster, and that requires you to kind of be much more agile. And that's why I think lifelong learning has emerged as a big, big component. You don't just get the diploma at 21 years old and be done with it, put it up on your wall and never come back to school. Now we're in a mode where we continuously need to download knowledge into our brains, otherwise we're going to be obsoleted by computers who do that every second of the day, right? So think about it that way. What does that mean in terms of mentors? You will have to have the equivalent of your college professor-ish throughout your life. And so finding those people that really care about your education, your improvement, your human enablement is going to be so key. So the way I do it is, like I said, I started teaching this class 5 years ago. I use a lot of that to help my entrepreneurs and my associates. I have a couple of associates that are kind of earlier in their career, and I sort of give them chances to fail, right? Give them an ability to write a check, and maybe that helps or that doesn't help, that maybe that works or it doesn't. I'm comfortable with that. I mean, obviously it takes a toll on your stomach, but it's part of learning the business. So you just believe in them as long as they're giving you back the effort and really being thoughtful about their growth. So having a growth mindset is super important. So I think mentors that are willing to kind of give you a shot and let you out there, let you stumble a little bit, I think it's super, super key.
Yeah, I think like the idea of mentors is such a big thing. It's like you're gonna have this person that's gonna help you for 20 years, and I think the way I tend to think about it, both like on both sides of it, is more about like having like making sure you pay attention to your personal network as well as your professional network. Like I don't think like you will very quickly find that like you cannot get the places you want to be by yourself. Like you need someone to help you. Like you always, I can tell, like I got off the wait list at NYU Law School because like a family friend, who I'd built a relationship, sent a letter. Like I got my job at Yahoo because I had done 3 deals with Marissa Mayer and like built a really good relationship with her, and she just happened to become the CEO because no one would have hired a lawyer to do a corporate development job at that point. Like it was a career switch. And so I think there's a lot of pressure, especially when you're young, to be like, I need to get a mentor. And it's like, I don't think you need, like, that's hard. Like, especially like, like I'll see people like email sometimes be like, will you be my mentor? Like that, it definitely doesn't work that way. I think it's like, the important thing to do is pay attention to relationships. Like pay attention to opportunities. If you work with someone and you build a professional relationship, like see if there's an opportunity to like keep that, especially if it's like, if you're I'm trying to think what a good example is, but like, just like build relationships and make sure you have like a personal network that helps you. Like, and like every opportunity is not going to do that. Like you're starting with like a great personal network. Like Boston College is like a really like other alums, like you'll see like it's a very strong network in that sense. So great, like leverage that. And then you'll have a professional network you'll work. When I worked at Google, I know like 40 people that worked at Google and they're now all over the place. And like that's like a professional. And so I think it's just making sure you carve out time as you're working, living, doing all the things you do to like have lunch with like that person you haven't talked to in a couple months, or reach out and send them an email or things like that. I think I don't have like I'm not particularly great at it either. So I'm not like here's the system, but I think it's really make sure that you carve out time for that. Because I think a lot of times like it's like people do professional networking and like that's a different thing. Like when you're doing that, you're not really building like friendships really, because that's what mentoring is. Like I think that's at the end of the day, it's not transactional. It's a friendship.
It's a give and take. Yeah.
And so I think that but like it's super, super important. Like I don't think even Google. So starting with Google, which is like my second job out of law school, like every job I got, I could tell you who helped me get it. I didn't like submit a resume anywhere. And so that's just the way the world works after that. And so, and like they weren't all like they some of them were like orthogonal kind of connections, but that's why you just never know. So, but yeah.
Yeah, one thing I was gonna say that you just kind of triggered is that I always use this term like you learn as much in the dorm as you do in the classroom, which means that exactly what you said is that you want to extend your dorm, like here, build relations. I to your point, I mean, I don't think I've done anything in my life without my networks that go way back to my undergrad, my business school, in Morgan Stanley, and maybe eBay as big networks, and then obviously a bunch of startups in between. But there was always like this relationship of these networks and friendships, actually more than networks, is people that you literally get to know in the dorm, right, situation, not in the formal classroom. So it's very interesting skills you get. There's hard skills, there's soft skills, but there's also people that can kind of help you in a non-formal way, like you said. So super, super important to do that. I agree.
I mean, I'll say like after you leave school, it's hard to build those relationships. Like college is like, you have a lot of like intense experiences, like spend a lot of time together, you all live together, and it's very easy to build strong relationships. Like after that, like you have to work at it a little bit, because like you don't have those opportunities, you have to kind of be intentional about it.
Yeah.
And then the last thing I'll say too is like, don't just focus on where people are and what they're doing right now. Like you just don't know. Like you don't know who's gonna go start their own startup or become the general counsel somewhere. Like so I try and like, my wife's always like, why are you meeting with that person? I'm like, I don't know, like, because I like them, and who knows where they'll go someday. Like, and so she's always looking at my calendar being like, what are you doing? But I look any given week still, I'm probably doing 20% of my time is like catch up meetings with people that I don't need anything from right now. Probably don't need anything from me. And so,
Yeah, I agree.
Yeah, awesome guys. I think some of the students wanted to hear a little bit about your funds and how you guys invest. So first, if you could explain what human enablement is and why you invest in it. And then if you could explain what fintech is and where you invest in it.
Yeah, I mean, I touched on it a little bit already. It's human enablement to me is how to use software, mainly software technology, to infiltrate it into situations where you could actually expose more opportunity to people. So good example I use is one of my companies that I invested in 2011 that kind of helped me grow in this theme is called Udemy, which is a marketplace for educational content. On one side, you have teachers that taught in classrooms this big and maybe made very, very little because teachers are not really valued in society as much as they should. I consider them to be pretty much heroes and they don't get valued like that. And so in Udemy, there's some teachers that are making over $1 million a year teaching to the world, right? Because now we expose them to a worldwide classroom, not just a small one, right? It's online. And on the flip side, and the receivers of this content are students that are now getting they're getting their material for $40, $50, $60, just bite-sized skills that they get so that they can get promoted, they can learn a new skill, they can get a different job, so they move up socioeconomically. So that's a great example of empowering of the theme itself. Is empowering a new type of work that enables you to have more access to improvements, socioeconomic improvements on the supply side. On the demand side, you have access to more education, so movement and socioeconomic mobility up. So that's an example of an education technology company that gives you more jobs, more skills. The third component is sort of how do you infiltrate inside a big corporation so that there's more mobility and all the voices get heard. So great example of some of the companies that have been doing that successfully are more communication companies like a Slack or something like that, where a person very low in the totem pole can actually have a voice in the corporation, so the cream rises to the top, and there's a flatter organization, more meritocracy, less favoritism, less nepotism. So there are a lot of workflow solutions that are doing that inside a corporation to flatten it out, to give more voice to people, and to essentially let people get promoted if they deserve to be promoted, rather than be cul-de-saced into little departments and politics of big companies. So I invest in that as well. So that's why I call it human enablement. It's all about socioeconomic enablement in 3 different ways. So more jobs, more skills, and more mobility, basically.
So, I mean, fintech is obviously, it's anything that touches money, like that, like to give it a broad definition. We think about it in a couple different buckets. And then, so one is what I would call so fintech infrastructure. So think like payments, things like Stripe, like that kind of like the back end of moving money. Commerce enablement, which would be something like a Shopify or a Square, which is just changing the way people and businesses interact with each other, maybe the best way to describe it. Consumer fintech, so things like Chime and Acorns and Robinhood and things like that. And then about 20% of what we do is crypto, blockchain, Web3. And then we have, I would say like those are our big buckets. We probably would, if we had a slide. But the reality then too is like I would call like there's like a bunch of horizon stuff. So it's like doesn't fit into any of those categories, but like we've invested in like a company that helps real estate companies manage like payments and background checks for their renters, sort of like, and that's like, I think that's prop tech is the term, but like it's like basically if money's moving, we're interested in, we look at it. So because PayPal, like our parent company is just involved in, I think your experience with PayPal is probably either PayPal or Venmo. But what we also own Braintree, which does payments processing. We have Zoom, which does cross-border payments, remittances. So like we just touch all parts of the money stack, and so therefore, as a venture fund, our job is to sort of help the company see around corners, and so we try and sort of look at across all of that. So
I love Venmo, by the way. I use it all the time.
I used to love Cash App. It's like a hard sell now for me. I've had to switch back and forth, but.
Yeah, awesome guys. I think people also wanted to know a little bit about how you guys invest, so what your process is, what you look for in founders, all that kind of stuff.
So on our side, we're a little like this is where I think our worlds are pretty different in that like because Sergio does earlier stage, but so by the time business gets to us, I think it depends. Like I mentioned before, like we're kind of like we bridge across like all of the pre-growth rounds. So Series A, B, and C. And so for Series A, like we won't invest like on like a seed investor in things that don't have like at least like you can squint at it and see product market fit. Like people seem like they want to buy it. That's for Series A. For B and C, like we're expecting people to be buying it. Like especially C, like Series C companies, like that looks more like a financial analysis exercise. We're sort of doing multiples and looking at that. For Series A, it's a good idea. It has some traction, and we think that the team can execute on it because the execution risk is pretty high on Series A, but the idea risk is lower because and so that's a lot of the evaluation we do. I would say, and this is another thing that's like Sergio will talk a little bit about being more thematic. Like we tend to be a little more, I think probably a little too much right now, reactionary in that like we do a lot of networking. We do a lot of networking with other VCs, and like we're evaluating things that come into us rather than saying like, hey, we have an idea that like this, that, or is changing in the market. And so we're kind of company by company looking at it and say, okay, that's good, that's bad, that's good, that's bad. I think like I'll let you talk about. I wish we did more thematic investment, which is more like, hey, I think this thing is going to change in the world. Let's go talk to all the companies that are doing that. But that's kind of how we approach it.
Yeah, I think that the only way I know how to invest now, because I invested in many different ways when I first started, and I just got my head handed to me in the first 3-4 years. Just back to the mentors. I mean, they allowed me to make mistakes, and that helped me grow a lot because I was very hard on myself and looked at myself in the mirror and like learned how to invest after 4 years of so the next 8 years became pretty freaking good, and I more than made up for the first 4. But the 8, what I started noticing is you have to have a point of view towards the future, and you have to have a point of view towards the what it means to be a great entrepreneur. Both of those, I mean, viewing the future and having a vision, plus having an entrepreneur that really does well, is they don't grow on trees. This is why I look at 400 deals, probably 400 or 500 deals a quarter that I actually meet with, process, right? At least I look at the deck and I like look at their demo and stuff like that. 400, 500, and I make one investment a quarter, right? So that's the type of funnel. And what I look for is this entrepreneurial mindset that has 5 or 6 components that include sort of the ability to find the product market fit, so great product market knows, sort of this commercial knows, this ability to have resilience, but courage, intellectual curiosity. There's all these things that I look for, which, by the way, they're the skills of the future in many ways. So if you're going to go through a lot of pivots in your career, like we have, you're going to have those skills, even if you're never going to start a company anyway, right? Because those skills in a fast-moving economy become the skills that make you survive and thrive, because adaptability is kind of the name of the game. Growth mindset is the name of the game. So I look for those, and then I like James said, I'm very thematic. So I sort of try to, with my associates, I really look for, and again, this is where the consulting or the investment banking or some of the services jobs that you may start with, I don't know, come in handy, because there's the rigor of thinking through a theme, so that you can paint the future for somebody that 5-10 years from now, this will come about. So that's how I found, again, Udemy is a good example. In 2010, people were saying EdTech is the worst place to invest. That's how you lose money. I said, well, yes, in K through 12, that's been the case, but why is it that we study from 5 years old to 21 years old, get a piece of paper, put it on the wall, and no longer study anymore? There shouldn't be like that. Like, we should be studying from 21 to 90, 100, continuously. So there should be that, and it's trillions of dollars, so why isn't there anybody out there doing it? That's how I came up with a market map that allowed me to kind of scan through the hundreds of companies that were trying that, made an investment, failed, said, no, this team's still good, it's just that I invested in the wrong team. And I did it again, and then it worked. So I think that's kind of how I do it, is I kind of think of what the world should be in 10 years. And then I backtrack and say, okay, let's be prepared to be surprised, because you're not going to incubate a company. You're going to be prepared to say, that's a good neighborhood. Let's figure out if that's the right house in that neighborhood, but at least you're in the right neighborhood, right? So it takes both skills of finding the right house to be a unicorn and make the returns that we need to return, so that he would invest in me again. You're on the hook now.
How do you guys manage your relationships with founders? So what does your firm do to support them? What do you personally do? And how do you, manage those pretty tough expectations that you have for them?
It's Silicon Valley is interesting in that it's like a very, it's a very founder-centric culture. And so I think like it's funny because like as a public company, a lot of boards are actually like view themselves as sort of the bosses of the CEO, right? And for the private company side, I think you need to be, the expectations are high, but I think it's kind of, in most of the relationships it's implied because like founders are so important and so key that like a lot of times they're kind of treated with kid gloves. Like it's like there's that part of it, unless things have gone, unless things are getting really difficult. But I find like there's like our job is kind of twofold. Like one is like PayPal Ventures in particular, like we have access to 40,000 PayPal employees. And so one of the things we're really trying to do is like understanding that like a Series A company, like the person running marketing has probably been out of school for like 4 years. And this is maybe their first or second marketing job. Like they don't know what they're doing. And like, how do you help them? Well, I have, there's probably 500 people at PayPal that do marketing that I can introduce. So we do a lot of connectivity around there, supporting our CEOs and supporting our businesses with like just our experience and know-how. But I also think like a lot of times it's just like your job is to like be a sounding board for the founders. Like when they're like, they just need someone to talk to that doesn't work for them. And I think it's being a founder is incredibly hard. Like if you listen to any of them talk on podcasts or write books, like sleeplessness is like a number one like symptom of founding a company like that. And it's not because they're working hard, it's because they like cannot go to sleep at night because they're worried about something. And so I think like helping them work through those worries is like the best thing you can do. And so I try and like, that's how I kind of view my founder relationships personally is like, what can I do to help? Like, do I just need to sit and listen to you? Like, I can give you advice here and there. But like, I also realize like, I've never founded a company. Like you at least have that experience. So I try not to be like, I tell them what I know. I tell them around the areas I do well, but mostly I'm there to sort of be a sounding board for these ideas. Cause I think you have to, even like investing is awesome. Like it's a fun part of Silicon Valley, but like that's the hardest job in Silicon Valley is being a founder of a company, especially as it starts to grow and you're all of a sudden responsible for 100 people's lives and you're in like, that's when like, yeah. I that's when I'm really kind of look at them and I'm like, well, that's like, they're braver than I am, but for sure. So.
No, that empathy is key. I think that's what I would start is like the word that comes to mind is empathy. The other thing I was going to say is that the way we're trying to build our fund, I've noticed that a lot of VCs, because they don't necessarily have that empathy, traditional VC, they kind of forgot, maybe a lot of them came from services, maybe financial services or something where you have a client and you have to serve the client. Citibank, Goldman, Morgan Stanley, we're all serving, these the CEOs of bigger companies, and so we're very service oriented, 24/7, that kind of thing. So I try to use that mentality for VC, and instead of the traditional VC is like this, we have the kings you are the kings of the kingdom, and people come to us and we give them checks, we turn them down. We're like sitting in an ivory tower. That world doesn't work. The way that it works is more like a service industries where we are servants to the entrepreneur. And to James's point, like we literally like are empathetic to them. We're coaching them. We're mentoring them in many cases, and we're helping them hire. We're helping them like structure their board. So all those things are. But we're 24/7. If they want us at 2 a.m, I give everybody my cell phone. Not that they ever text me at 2 a.m, but they're up. I mean, it's tough. Both VC and entrepreneurship is tough. On the stomach, like I said, while other jobs are tougher on the stamina, physical stamina, but you don't take the financial risk. And in our case, both entrepreneurship and VC, we take the financial risk. So the hours are not crazy as they are in other places, but the stomach acid is high, right? If you don't know how to process it. So I empathize with that, and so we help them that way. For example, one of the things we just started doing is we send surveys. As soon as we meet with an entrepreneur, we send them a survey for them to give us feedback. And this is after we turn them down, right? Because we turn 99.9% of the things we see. After we turn them down, we said, regardless of the outcome, please give us your feedback on how we treated you, how we, and so we're trying to get feedback so that we could get better as service providers, because I've seen many times where we just don't treat entrepreneurs the right way, and that's just not the way to do it.
though this approach I will say like can be very challenging. So it's also we're in like a 10-year bull market run that's ending, and like I think the one thing I'll say is as business times get hard, if something starts to work or if the CEO like it can be hard to flip that switch, but it's also our job at some point. Like we have to protect. We both have capital that we manage for other people that we have to protect, and so I do think that can be the hardest thing is like having to make that switch from empathetic sounding board to okay, like this isn't working, and I'm like now I'm an owner of this business. I need to interact there. I think we haven't honestly. I haven't seen too many of those situations over the years, but I think it's going to become more of a reality like in the next call it 2 or 3 years as the market turns a little bit and funding situation gets a little more difficult.
Yeah, switching out the CEO has been the hardest.
That's the thing you like. Every venture fund, most of the venture funds would be like, oh, we never do that. We don't want to do it. But the reality is like sometimes it is.
You have to do it.
Sometimes it has to happen. But that's hard. It's not. That's I think one of the hardest things we have to do is like that switching that relationship from we're in this together to like we're like it's not working. Like, how do
you
we
could be a shareholder, but you're not going to be running the company anymore. So that's tough.
Yeah, I think we have time for one more of my questions before we open it up to everyone. So if each of you could highlight one failure from your lives or careers and sort of tell us how you got there and what you learned from it. I think we can do that and then just open it up to everyone else for questions.
So one of the jobs that's on my LinkedIn, I think I may have taken it off now, that I didn't talk about was before I went to Square, after I left Andreessen. So I was at Andreessen Horowitz, like fun venture capital firm. I went and worked as like at a movie studio down in Los Angeles. Like it was a startup movie studio. And I went with like the former head of marketing at Yahoo. So it was like, it seemed like it was gonna be great. And it was not great. Like there's a reason why Silicon Valley and Hollywood don't work well together. Like they're like from different worlds. And so we were gonna go solve that. And I think we actually had a good idea, but I found myself unemployed 4 months later. The culture didn't mix. Like we both, like they shut down the group. So that was like that was not a good financial trade, but I do think that the experience, I think it showed me, like, I think part of that was like, I really wanted to try like business development. I wanted to kind of break out of what I was good at and try something new. And so I did something kind of funky to do that. And I think what I did is I took a step back and said, like, those big leaps are a little too much for me. I kind of like focus more on like quarter turns as I try and like move my career rather than like let's go do Hollywood. So that was like I said, it worked out fine. I ended up at Square, but it was there's definitely a moment where I think at that point I'd been out of school for 15 years and you find yourself for the first time unemployed unintentionally. It was interesting.
Yeah. I was similar. I always go back and quote one of my CEOs who's actually a Bain consultant, and she turned CEO of eBay. And so I was in a meeting with her, Meg Whitman, and she said this was after I had gone through some career stuff, which I'll talk about. But she said, I think we have a lot of people here with too much college, but too little kindergarten. And that to me like really stuck because that was the initiation. Like my first mistakes that I made in my career was literally thinking that I was really smart, but not having enough EQ and time to build relationships and build connections. I think BC does this great. Another reason why you guys, if you stick together and you have your alma mater pride, you will build some great companies. You will build a great career. My biggest mistake was along those lines where I came out of business school firing with all engines. I was going to conquer the world. I was all performance, and didn't realize in a company, I'd worked in companies, but not very many, more in a service environment, like I said. So in a company, you have to kind of spend time really building the relationships, nurturing the culture, building some sort of long-lasting sort of thing, sort of networks. And I didn't do that. And so like year out, like it just, I said, this is way too slow moving. There's too much chit chat in the cooler, whatever. And I was like not embracing it. And so I that was a debacle. I mean, after 1 year, I left and started a company, which I crashed then. That was another story. But it was learning that you do need to take time to really exercise your EQ as much as you exercise your IQ, basically.
Awesome, guys. Well, thanks for doing the Q&A with me. I think we like to open it up to any questions in the audience for the remainder of our time.
Thank you guys for coming and speaking to us. I think it's easier to see how a recession affects a larger public company because you can look at the headlines and the earnings reports and the stock price, but what are some unique challenges that the threat of a recession or rising interest rates poses to a young company? And what advice do you find yourself giving these founders during this time?
Yeah, I'll start if you want, James. So I just I lived through the 01 and 10 recession, so I have a playbook that I try to use that I learned in harsh environments like that. So the first thing I did as soon as the market turned in January, February, is I instituted a health check. So almost like you're like now running an, hopefully you're not running an ICU, but you do sort of set up your hospital ready to go. And you do health checks. So, just like you would in any kind of patient that has some sort of teetering things. But I did it for all my companies. So I did a full health check to make sure I know a zero cash date, a runway, a pipeline, things like that would forward look into what's going to be the cash situation down the road. This is, again, where the finance modeling comes in really handy. So I did that. I realized that there were two companies that are more ICU candidates than just regular patients, and so and there are some that are just rocking it. They have 24, 48 months worth of runway. They're doing well, and their pipelines are strong. They're not teetering. So like those are great. I focus on the ones that were unhealthy or soon to be unhealthy, and so quickly I'd like to deliver bad news quickly. So I marked them down. To my investors, said, hey, these guys are maybe, I think they're gonna make it, but I'm not sure, right? So you gotta kind of deliver news fast and then work with the companies. So we're in one company, we're having those tough discussions that we think it's a feature, not a full company. So we're very quickly moving towards potentially M&A, which may be an acqui-hire, in which case we may make 30, 40, $50 cents on the dollar, which is better than a zero. So we do that as a playbook. The other thing that we can do is to kind of trim down the burn and then retool the team, retool the focus a little bit so that they have a longer runway. The other thing we do is that we strengthen the syndicate. So we go around all the investors that are inside because they're already invested. If there's no outside round, the next best thing is to do an inside round. In the inside round, you have to have kind of lock arms with your investors in the inside and say, let's bite the bullet and let's give the company another chance if they merit another chance. If not, then you actually try to sell it. So there's all these like levels of care, healthcare that you give, but you basically are running a hospital at that point.
There's a lot of hospital metaphors going on right now. Like everyone I talk to is has a similar. The other thing that's really challenging in this environment is valuation. And so whether it's like if people are going up around or what you're carrying it on your books is because public company valuations like provide you kind of like the earlier stage you are, the further you are from that mattering, right? But obviously public company valuations in fintech are half what they were a year ago. And so does that mean every fintech is worth half what if they raised last year? Like it's hard to tell. And I think that's one of the challenges we're seeing, not for our portfolio companies, but for getting deals done is like there's like not a market being made. Like the founders and investors don't have in their minds what things are worth right now. Because and it's I think that's something it's like by the time like you all see it like as something like someone raises money at X valuation, it's sort of like it seems like there's there's a system to this. Like everyone knows like valuing private companies, especially private tech companies, is incredibly hard in an environment where everyone kind of uses the same metrics. Now for the last 6 months, all those metrics have been thrown in a blender. And like I think it's like that's the first thing. So like knowing what things are worth right now was always hard. Right now it's nearly impossible. I think the second thing is like for the companies in our portfolio, I think what we're telling them is like the fundraising environment is going to be hard for the next year at least, if not a little bit more. And so like try not to fundraise, like do what you can to not be doing that. And so we did that. Like we looked, we saw everyone was good. Everyone had 18, 24 months of cash left. I think what we're starting to see now is like when you get that, like there's a numerator and a denominator of that like cash left equation, and like revenue is starting to like up until now I would say like we haven't seen a lot of business degradation. Like stock market's down, valuations are wonky, but like businesses were going along fine. We're starting to see more businesses miss their plans. And if you're missing your plans, that 24 months assumes that you were hitting your plan on revenue. If revenue starts going down, you might go from 24 months to 18 months to 12 months very quickly. And so now all of a sudden you need to raise in Q4 2023, which we think is like the worst possible time to be raising. So I think the newest thing we're starting to push is like you need to build a recession plan. And like that's hard because a lot of the VP of finances like haven't like worked during a recession. Like like if you think about it, you could be in the finance industry for 8 years and have graduated after 2009, 2010. And so asking someone to build like, no, I don't want your down case, I want your recession case is one of the challenges we're looking at right now. Because I think if you don't plan for the top line shrinking, like you're gonna find out very quickly that your cash balance disappears faster than you can. And like look, I mean, I said all that, like it doesn't make sense that it will be hard to raise money next year because there's so much money in dry powder in venture right now. And like you don't get paid in venture unless you call that capital. If you have a fund, like as a corporate, like we're different, but like, so there's, everyone raised huge funds on Sand Hill Road last year. So there's billions of dollars of capital to get. I think it's just going to be, it's going to be at terms that people might not like, which is why we're kind of telling them to stay out of the market. I think it's going to be, there's going to be a really interesting tension over the next like 18 months between all that dry powder and like people feeling bad about the economy. But like if you invest in a Series A company, like they're going public in 2027. Like what? So a part of me is like if you find good companies, like invest in them now, because as long as they can sort of survive throughout it, like they're going to live in a totally different economy than we're in right now. But that's hard. Like it's hard to like when you're reading the newspaper every day and like you're seeing your large businesses struggle to like then look at a Series A and be optimistic. But like if you're not optimistic in venture, like you'll never write any checks. So
the optimistic side of me says if I look back on 2010, it turns out to be the absolute best vintage for creation of new companies. That's where Airbnb was born. That's where Uber was born. Like there's some massive companies, and if you look inside just 2010 alone, it was a pretty depressing time. So, but you had so much access to
you guys
great
were all
people.
8, right? Like, yeah.
So
I did a like total aside. Like I did like a 90s Peloton ride with my team, and they were all like, they're like, we weren't born in the 90s. I was like, I don't know.
I did a case study.
I was like, I'm not doing Peloton rides with you guys anymore.
I had to show people what a Walkman was because I was trying to do the predecessor of the iPod and the iPhone. They didn't know what the iPod or the Walkman were.
But so it's I don't know. Like it's like macro. It seems pretty depressing out there. But like you're right. And the other thing I'll say is the reason why those businesses were really successful in 2010 is they were raised in an environment where you had to have a lot of discipline. Like it was harder to get capital. You had to run your business well. Like I don't think that's been true the last couple of years. Like really a lot more focused on growth and building your business than like really strong discipline in running your business. Like that's 100%. Even as money goes out, there's gonna be like show us your CAC, show us how you're spending those marketing dollars, show us the ROI on it. Like there's gonna be a lot more focus on that, even for earlier stage companies. So in that way, there's probably like the tough economic times just drive better outcomes because the businesses are run better. Like they're just forced to be. So.
Yeah. Thank you.
Yeah, good question.
Do you think that like those tough economic times also breed great companies because then there's like a consolidation in like the labor force and like the startups that are failing, the good people from those startups that failed are then joining the better startups and creating stronger teams there?
I think it's something a little bit different in that like like Google and Meta hiring less people and having less money is good for startups because they're really hard to compete with, right? They pay people a lot of cash, and their equity has been a great investment as an employee, right? And so like they pull, like, especially engineering talent is very, very hard to compete against them. Like that's like every startup, every private company will always sort of like bemoan the fact that, like, Google pays, Stanford grads like $275,000 a year in cash, right? Like you can't do that. And like the CEO at a startup doesn't make that much. And so I think it's been an employee's market for a while. If unemployment goes up, that will change, and that will help startups too. I think on the talent front, it should be generally positive. I think the inflation doesn't help though, because I think like you're always trading like that future equity lottery ticket for like a low cash salary. And so if inflation starts to really put pressure on people, like on making, that lower cash salary work, which is always going to be a startup thing, that's going to be tough. And so I think there's probably goes a little bit both ways. But I do think like the other thing is like, there's just like people will break loose from the big companies as the equity price go down because they have less keeping them there, right? Like that's why people kind of get stuck, because they have these equity grants that are vesting. If they're worth half as much as they were, those people are probably twice as likely to leave now. So that'll be good. It's going to be, where unemployment goes and where inflation goes are going to be really big factors in that though. So
I think it's self-regulating too when there's a place that no longer looks so pretty because there's been a slash and burn situation, the tourists leave. So the only ones that stay are the ones that are really committed. So I see that all the time. We saw it in '01. There was an evacuation of the epicenter of that slash and burn in 2010 as well. So right now, people that are not really that committed, they thought like, oh, cool, VC's fun, it's sexy, you make a lot of money. Like they're like, oh shit, this is hard, I'm gonna leave. And so the tourists leave, the ones that really are committed stay, and that's better for everybody, right?
Well, on the VC side, there's going to be less LP money in VC, just because as interest rates go up, like LPs, like other than corporate LPs, but like LPs that are like pension funds or university endowments, right? Like they VC's an allocation, like they have buckets, right? And like VC has been over allocated versus its historical allocation because interest rates have been so low. But these folks, like, they want to make 3%. Like that's what they're looking for. If they can make 3% in T-bills, like they're going to take it out of VC and put it into T-bills because they don't get paid to like take a lot of risk, right? They get paid to like grow that giant pool of money a little bit more. And I think because interest rates have been so low that the risk-free rate has been essentially zero. And so in order to chase that 3%, these big giant pools of money have been putting more into VC. I think like going forward, if we go into like a more normal, like for you guys' lives, like normal has been really low interest rates. Like for the history of like the last 50 years, we're still low, right? Like I think the average over 50 years is like 7 or 8% is the Fed rate. And so if we start to go back towards that, I think that like venture will become harder and harder to raise, especially if you're a new fund. Like I think if you're Sequoia, you're always going to raise. Like you're Sequoia, you have 50 years of history. It'll be harder and harder to be an emerging fund manager unless you have like a really good pedigree. I think that so it'll be. I don't know if that's my kind of prediction as interest rates go up, but it's there's also just like I said, like everyone just raised money, so I think there's a lot of pressure on the market. So I don't see like venture as like as a growth industry for a couple of years at least. Right? So because I just don't think. We'll see. Like everyone, all the big Sand Hill Road funds will need to go out in 2023 probably to raise their next funds. So like it'll be interesting to see what's changed then. So if they can all go they all raise $1 billion funds, which is it's mind-boggling to think about like doing like Series A investing, like 10, 15, $20 million checks and doing it $1 billion of it. Like it's just so much work. Like that's so.
I hate to cut you guys off, but I think we're at time. If we give a round of applause, thanks.